Welcome. Welcome, everyone. It's Angelo Robles. And those that are live, it begins the week on a Monday night at 8 o'clock. And I look forward to tonight. It's been a busy last couple of days for me doing these lives, so many topics to cover. And in a couple of days, I'll be traveling where I hope in greater Los Angeles and beyond to do maybe some on the spots, 5 or 10 minutes. But we'll see if that happens. I said that in Miami and Palm Beach and never did it. So here in home studio, lots on my mind. I teased this one out last night, effectively around the sovereign adaptation, AI era investing when moats collapse. So I think you will enjoy this. And without further ado, on my solo tonight, I promise some great interviews coming up this month, but I've been on a run here in my solos. I have a lot to say on this one. I think you're going to find it very valuable and engaging. And without further ado, the sovereign adaptation, AI era investing, when moats collapse, what sticks, what goes, what adapts, and what's new? So let me be direct. The world has shifted from incrementalism to exponentialism. Not to get too fancy on the words, you get the idea. And most portfolios are still built for the former. That's the problem. Now, time constants are always compressing. A 10-year runway can collapse, easily into 3 much sooner. A static moat isn't an asset anymore. Actually, that is the definition of a target. If your investment thesis relies on things staying the same, you aren't investing, you're hoping. So tonight, and I'm going to name names tonight, they'll be exciting. 4 things. First, the framework has been compressed. We'll get into that. What still works and kind of what's a word that I use, kind of quietly broken. Second, the new principles, the ones nobody was writing about 3 years ago. Third, as I hinted at, the names, public equities, I may do 1 or 2 exceptions to that, I think matter for the AI build out organized around the real bottlenecks, which are around power, optics, efficient compute. Oh, that's a big one. And enabling the infrastructure. Fourth, we'll go over what one of the sharpest hedge fund minds in the game, looking at the 13F, we get a partial picture of what he's doing now in real dollars. That'll be fun. And wait till you see the one that I single out. Then we wrap up where this takes the conversation, I guess you could say, deeper. Now, I know I did a variation of this 3 or 4 months ago. Things change, and some of my picks have even changed. So we're going to take a new try as 3 or 4 months in today's world. It feels like a year and a half, 2 years, how things used to be. So the framework compressed. That's the point. For years, I've been evaluating companies through kind of 9 lenses: moat durability, cash cow traits, runway and tailwind, supply demand dynamics, growth quality, capital allocation, founder CEO excellence, relative value, and risk. The framework built fortunes in the pre-AI world. So now we stress test it. So what still sticks? I think the iron law of cash is oxygen. If a company can't turn kind of a prompt in today's world into a dollar, it's really a hobby and not a business. Capital allocation mastery still separates winners from losers and now decides whether AI CapEx compounds or evaporates. The founder obsession to me endures. We bet on the builder over the observer. Relative value, iron law, untouched. What goes? Let's see. The obsolete metrics, to me, quarterly latency. If you're waiting on a 10Q to tell you a company is growing, you're probably 3 months too late. We need a real-time signal. Linear 10-year TAM runways collapsed. Geographic borders are dead for AI. Autonomous agents scale instantly. What adapts? The new moat, fabric moats transform. Process moats dead. AI effectively automates them. Data network effects, brand equity to me is soft. Proprietary data loops, well, that's different. That's hard. Switching costs 2.0. It's no longer about software lock-in. It's about AI integration debt, how deeply embedded the model is in kind of the customer's actual workflow. The new moat question isn't how strong is this moat? It's, is this moat AI proof, or does AI commoditize it? That's really the key question. Now, supply demand kind of inverts. The new constraints are compute. That's a huge one. Energy and inference cost curves. Forget Moore's law. It's done. Watch dollars per token. Risk frameworks are expanded. Add AI displacement. Add commoditization speed. Inference cost or inference cost exposure more specifically. Add energy availability as a category one threat. Now, here's where it starts to get interesting, kind of what's new. 5 emerging principles. 1, the AI leverage ratio. We are looking for operating leverage kind of on steroids. If revenue per employee isn't going exponential, the company is trapped in a legacy cost spiral. Come on. 2, inference economics, gross margin sensitivity to compute. Cost per query trends, energy access as a moat component. 3, data moat quality. Proprietary data with reinforcement loops beats public data. Usage that improves the product, that's the new compounding. 4, speed to adapt, really important. AI native, or is AI simply just bolted on? 5, human AI, kind of in some ways complementary, kind of a taste, a curation, a strategy, a capital allocation. These get more valuable as AI handles the commoditization, so to speak, of work, not less. The core insight. Here's kind of the shift basically in one sentence. We are moving from durable competitive advantages to compounding adaptive advantages. Winners accumulate data, compute, and network effects faster than competitors kind of can AI copy them. Losers have static moats. AI just learns and replicates. So the new question, the one that I now ask, so to speak, of every position, and we're going to primarily be public equities here. Does this business get stronger or weaker as AI gets 10 times better next year? Simple. Does this business get stronger or weaker as AI gets 10 times better next year? No, it's not hypothetical. That's the world, unless something changes. That is the world that we're in. Now, not to get too far off course here, but I think this is an important comment to make, which even gets back to Wall Street. Kind of my part 2 is what I call the Musk discount. So I admit it's a quick aside. It frames everything that follows, so it's important. Wall Street trusts Buffett. We all love Buffett. Come on, he's like America's great grandfather, because Buffett operates inside the existing system. It's incremental, familiar, and 50 years of amazing over most of that time of capital allocation. Musk is different. Elon isn't an observer. Oh, he's a builder. A career of turning impossible into industries. Come on. We're going to get a little bit to SpaceX, Tesla, a little bit. Reusable rockets, mass market EVs, global satellite internet, frontier AI, etc. But when Musk, I noticed this, when Musk talks about what's next, humanoid robots at scale, post-scarcity energy, you know, data centers in space, optional work, what I mentioned on space industrialization, investors treat it what feels to be almost like science fiction, not as an investment guidance. The market seems to always trust, and oh, did they get NVIDIA wrong? Really going back, what now, 3 to 4 years? The market trusts observers of the present more than builders of the future. The market practically almost needs, and did they get Tesla wrong, especially looking back over 10 years? The market needs Musk to be wrong, because if Optimus happens even late, and his timelines could be a little labor intensive industries, they get repriced overnight. If AI driven deflation takes hold, service sectors lose pricing power. If energy becomes abundant, utilities and commodities are mispriced. If space industrializes, earthbound assumptions, they collapse. Wrong on timing is the psychological cover. It lets people, I think, nod politely and ignore effectively the implications. Markets dismiss Musk not because he's usually wrong, but because he's often right too soon. For investors, I believe, would you agree, that direction does matter, especially a bit more longer term, more than timing. Now, hold that thought as I go into part 3. Context kind of before the names. I promise that's coming. Some of them. Before I list anything context, this depends, of course, every investor has different goals, capital base, liquidity needs, risk tolerance, timeline. A year or two ago, the answer for most was actually, even most family offices, broadly pretty simple. What are the goals? Have a strong and detailed investment policy statement and asset allocation properly structured for you with risk mitigation and parameters, and sit on quality and be patient. That approach may no longer in today's world be tactical enough because moats are collapsing in real time. Look at mid-tier SaaS companies. Look how fast AI is eating that workflow software. Patience without nimbleness now, to me, has become a vulnerability. Real estate, less of my edge, hyper-local, hands-on, shaped by demographics, definitely rates, interest rates, can absolutely work. And with tax advantages and leverage, maybe work incredibly. It's just not where I spend a lot of my analytical time. And larger family offices, they have other levers. They have more cash, LP access to elite funds, interest in uncorrelated assets, including sports teams, direct deals. If you have the internal team, especially, those are real. Tonight, we're going to focus on some public equities where the asymmetry is most easily accessible. One honest disclaimer before names. For most investors, it's boring, but let's be honest. Let's just be very honest. The triple Q will likely outperform most active managers over time. You'll get increased volatility, but you'll be liquid and with less fees, and that matters. It's just the math, or has been in the past, no guarantee moving forward. So why even bother picking individual names? Because in this specific moment, I believe a focused AI-centric basket for a part of their portfolio can outperform if you're early to the right infrastructure. And for me, effectively, that is the bet, if I may call it that. At the end of the day, the stock market, I guess, is what, another form of gambling, I guess you could say. Many people say that. You cannot get out of the rat race. You cannot go to another level. You cannot beat effectively inflation if you don't own assets that go up in value. I know what it's like to be dirt poor. I know what it's like to even put $10 or $25 a week together. You have to figure it out. If you're very early stage, as a young person, as someone who's struggling, you find a way to enhance that your skills you invest in and focus on have utility and have economic value. And you begin, even if it's modest, you get the mindset and you get the power of compounding to invest in resources like public equities, like real estate, and other assets that could go up in value, historically have done it over time. By the way, I mentioned the Triple Q was not around in 1975, but if you could backtest for kind of a NASDAQ 100, the Buss family purchased the Lakers in 79. I did this back last summer. They sold it just last year. You would have made like 2.5 times your money in the public stock market in a Triple Q. And even the S&P was about the same. Do you get the glamour of the Lakers? No. Do you get certain net operating losses on how you structure the entities? No. I get it. I would rather own the Lakers too. But I'm just saying, you could do incredibly well. You need to be active in owning assets. It's just, come on, it's obviously imperative. So, and again, for most investors, even many billionaires that I know, they keep their public exposure to ETFs and strategic limited funds. And for many, it may be the right call. Do you think that most hedge fund managers are outperforming over blocks of 10 years? Some of the public, some of the ETFs and things that I'm talking about, they don't. You may have less volatility. You may hit someone who's truly gifted at the right time. I hear you. And I get it. A lot of you feel you don't even have access to that, so it's not even an opportunity. A different subject for effectively a different time. So almost everything tonight that I'm focusing on, and there's wonderful companies like Casey's General Stores and Costco that I love, but I want to focus on AI infrastructure. The hyperscalers will spend roughly $650 billion on CapEx in 2026 alone. That's bigger than the Apollo program adjusted for inflation. The picks and shovels layer is where the money is going. Kind of four bottlenecks: power, optics, efficient compute, and enabling infrastructure. And then a few special situations. So bottleneck number one, power for sure. AI is fundamentally really a power story. Compute eats electrons. And the grid, effectively, the grid cannot keep up. Going back to what I said earlier, why even invest in individual securities? I wouldn't if I didn't feel they're going to beat the index I'm comparing it to. And the reality is, for most investors, being strategic and tactical in indexes through likely ETFs, it's boring as hell. It's probably going to be the best answer on public equities for the vast majority of people. I'm only going to be tactical from my perspective and my experiences, and I'm wrong my fair share. Choosing individual selections, maybe as a core satellite strategy, when I feel I'm effectively getting an edge and I think the market's slow to catch up and I'm going to beat, quote unquote, the index. In terms of my private community of family offices, we do some private gatherings, digital and in person, where we go around the room. What's your favorite idea, your favorite thesis? Why do you have it relative to investing? What's the biggest mistake? What are you getting in? What are you getting out of? And one of the things we do in some of my cohorts are some incredible investors, allocators, and family offices, and being part of a private community where we could openly share our thesis, our challenges, where we're going wrong, what has not worked. And it's a pretty good list. But also what has worked and what was our thesis behind it? How did we size it? How do we mitigate our risk? What did we do? That's part of being part of a special community where you get that. So in terms of, I did mention, I know everyone. Yes, I'm getting to some names. And again, invest at your own risk. These are mostly going to be public companies. And when you invest, you could lose money. You could lose all your money. So in that bottleneck number one, power, I like Vistra Corp. That's VST. one of the largest competitive power producers in the country, massive nuclear and gas fleet, aggressive on data center PPAs, including the Meta nuclear deal, positioned for ERCOT tightening. I like Constellation Energy, CEG, largest US carbon-free generator. 3 Mile Island restart for Microsoft. Long-term hyperscaler deals with Microsoft and Meta, actually. These aren't utilities anymore. They're really fuel cells of the AI revolution. I'm interested in Talon Energy, TLN, owns Susquehanna, co-located nuclear direct, what they're doing with Amazon, the cleanest pure play on the nuclear to data center thesis, at least I think. Cheniere Energy, a big brand, LNG, largest long LNG exporter. The honest answer to how do we scale AI fast? Probably gas turbines. Cheniere is a significant company, I think very well run and upstream of it all. Ormat Technologies, interesting. ORA, US geothermal, 24/7 baseload, zero carbon, no fuel volatility, direct PPAs with hyperscalers, including one up to 150 megawatts to Google through NV Energy, vertically integrated. Oh, one that I love, and that means it's going to go down. And a big brand that many of you are going to be familiar with, GE Vernova, GEV, gas turbines, grid equipment, grid software. Ooh, that picks and shovels is good. Already capacity constrained on gas turbines well into 2028. The order book is the AI thesis made physical. I like Caterpillar, CAT, diesel, gensets, backup power, earth moving, directly linked to 2 gigawatt alliance for dedicated data center power. Kind of a surprising to a degree, but you got to think about it a little deeper in the infrastructure and the build out. Vertiv, VRT, cooling, power management, AI chips run hot. Liquid cooling is no longer optional. It's mission critical for infrastructure, and Vertiv kind of sells the answer. And one, I know they're hyper trendy, and the burgeoning, amazing hedge fund manager that I mentioned that I'll get to a little bit soon on his 13F. This is probably maybe among the most significant holdings. I love them too. Bloom Energy, BE, solid oxidized fuel cells on site behind the meter generation that deploys in months, not years, when the grid interconnected queue is 5 years long. Hyperscalers build their own microgrids, and Bloom, for now, who knows, is what they buy. So the proof, record annual revenue around probably $2 billion. I know we're spending a lot on this one. Roughly 30% gross margins, backup log for 2.5 times, an Oracle agreement for up to 2.8 gigawatts, a separate up to $5 billion AI partnership with Brookfield, the iconic company, a $2.65 billion agreement with American Electric Power on a 20-year offtake. Fuel cell, flexible, solid state, near instant load following, 90% plus efficiency in combined heat and power, already powering more than 400 megawatts of data centers worldwide. Risk, capital intensive, long sales cycle, fuel source debate, execution is backlog, converts. So you probably, again, you have to size accordingly. You don't want to have all your eggs in one basket. And definitely, I don't think more than 5% in any one company. Bottleneck 2. This is an interesting one. And this is a deeper dive into data centers beyond the surface of maybe how many of you look at broadly AI and picks and shovels. Photonics, the speed of light play. Inside hyperscale AI clusters, is copper kind of dying and light is winning? This is the photonics layer, the engineering of light itself to move data inside the AI cluster. Optical interconnects are the nervous system. Fiber optic glue is kind of where the money flows. And this is where some of our incredible investors, as part of our community at SFO Continuity, some great ideas. Lumitum, LITE, the flagship, optical and laser components for hyperscale and telecom, up triple digits in the past year on AI, effectively optical demand. Uh, Now, we're going to get to the hedge fund manager a little bit later, so we'll come back to that. A boring company coming up, but oh, they're doing interesting things and work perfectly into this, and that's Coordinate. Who would have thought? Company, what, 130 years old? The glass company, GLW, specialty glass and fiber, just signed a multi-year meta deal worth up to $6 billion for AI data center fiber, multi-core fiber, co-package optics. I know, boring, but durable and very indispensable. Applied Optoelectronics, AAOI, optical transceivers and modules, hyperscale 800G orders, smaller, more volatile, but levered directly to effectively the optical refresh cycle. AEHR test systems, AEHR, I guess, symbol, wafer burn or burn in for silicon carbide and photonic chips. Tiny, way more volatile, but strategic. The test layer for kind of the next generation of the optics ramp. AXT or AXTI, the bet on indium phosphide. Interesting. Look that up. The substrate behind high-speed AI optical networking. Backlog growth tied to scale-out optics. I hope you're all enjoying this. There may be one good one among this. You'll see. We'll check back in a week, a month, 6 months, and a year. But oh my God, staying too long-term in today's world, it's careful. You may have to be more tactical, but maybe a subject we hinted at we'll come back to at a later time. Sivers Semiconductors, Swedish small cap lasers and millimeter wave for high-speed optical transceivers. Really interesting company, including a $1.6 trillion partnership with Jabal. Speculative, but they have real IP. So bottleneck number 3, a huge one, efficient compute. Every watt that doesn't get wasted is a watt you don't have to generate. Nubius, NBIS, kind of the CoreWeave competitor, smaller, growing even faster. Reportedly, who knows, signed roughly a $27 billion Meta deal. Boy, Meta's been really active. Microsoft is a customer. NVIDIA invested $2 billion. High multiple, capital intensive. This is the bet that GPU shortages probably last. I'm going to leave it at that one for that bottleneck. Again, there's some things I keep only for my members. I'm being more open than I normally am more publicly here. Bottleneck 4, enabling infrastructure, Sterling infrastructure, really like them. STRL, the architect of the build-out, site development, and specialized construction for megafab and data centers. The work small contractors kind of can't touch, they could. The shovel before the building. Texas Pacific Land, TPL, kind of the royalty king. Land, water, and easements in the Permian. Capital light, almost no incremental capex, collecting checks on every drop of water, every foot right of the way the AI build out simply requires. Teradyne, some would say a boring pick, but hey, you got to have some. TER, semiconductor robotics test equipment. As silicon gets more complex and humanoids robotics ramp, Teradyne sells kind of the validation layer. SanDisk, well known, maybe a little overplayed. SNDK, AI is memory bound. OpenAI alone has reportedly contracted up to 40% of global DRAM capacity, and NAND and DRAM are the silent kind of winners, I guess you could say, in this. A Carpenter Technology, CRS, specialty alloys for aerospace, defense, and energy. The AI build-out drives the defense and aerospace cycle, and Carpenter is upstream. One I'm really interested in is Clean Harbors, CLH, hazardous waste, industrial services, environmental remediation, quietly essential to the build-out, boring as hell, recession resistant, and for sure, mission critical. Now, those are maybe some exceptions there. We can argue a little bit more of a satellite. Would I make any of them a core? No. Do any of them even smell 5% of my public equity? No. Are some of them more a foot in the door? I believe in ETFs. I have them. I believe in some diversity away from the US and the US dollar, AKA emerging market. Sure. But I enjoy and talking with investors and sharing ideas. And for a modest part of my public portfolio, you could argue maybe it takes overly an amount of time. Am I really getting more value long term? Am I getting in and out at the wrong time? All debatable. In the end, do your own diligence when you invest, especially in more aggressive companies like this. You can absolutely lose money. And like I said, all your money. Do I believe with some of this, I could get some VC-like returns in public market? Sure, but it does need to prove itself. But I like the mental stimulation, the work and the research, the collaboration with peers, and putting a very, very modest amount in some public companies that are easy to allocate to. And it gives me an opportunity to track them and see if I want to up some or part of my group, some specific holdings. Now, I got some classic holdings too, kind of, you know, why I would own these. Sure, I do love Tesla. We've been over this, really no longer, and hasn't been for a while, a car company. By their own framing, really AI, robotics, energy, Optimus, FSD, energy storage, Dojo. Even if Halfland, the auto framing kind of becomes irrelevant. I love Jensen Huang at NVIDIA, a keystone for me. Maybe that changes in a year or two. Again, the days of hold it and forget about it. I wish they were still here. They're just not. The world has changed. So still, NVIDIA is the tax collector of the AI build out. The question isn't whether, it's kind of almost at what multiple. And a little off topic, but related, I like Eli Lilly, their GLP-1 leadership and deep pipeline. AI is accelerating drug discovery. Lilly is positioned for both, to me, demand and supply, quote unquote, sides. So the inner cohort, even more speculative than what I mentioned before. And these I would for sure probably keep under 1%. Is that diluting what I do? Maybe it does. I find Kraken Robotics interesting. Canadian ticker, PNG, US over the counter, KRKNF. Underwater robotics, subsea sonar, and critically subsea batteries, key supplier to Anduril for unmanned underwater vehicles, roughly $28 million in new orders just announced across multiple countries. The next conflict, including underwater, we could say runs through platforms like this. I got to keep the crypto bros a little happy here and there. How about BitSensor? Token Tau, decentralized AI compute and model marketplace. Pumped hard recently, token, not equity, sized like venture, not core. I find D-Wave Quantum to be intriguing. Public market quantum play, real, but timeline, boy, very uncertain. Long dated optionality, definitely not core. One day quantum will be here in a big way. And I don't know who that winner is going to be. Of course, none of us does. A little bit of an indirect SpaceX. And so SpaceX for now is still private, but April 1st of this year, SpaceX confidentially filed an S1 with the SEC, confirmed by Reuters, Bloomberg, etc. The target, wow, roughly 1.75 trillion valuation, summer listing, largest IPO, obviously, in history, and includes XAI and with SpaceX merged with just really a couple of months ago. The question isn't necessarily whether to wait, it's whether there's a public market wrapper to own now before kind of a IPO repricing, I guess you could say. There might be. Look at EchoStar, ticker would be SATS. Last year, EchoStar sold Spectrum to SpaceX in 2 deals. Net result, EchoStar now holds roughly $11 billion of SpaceX stock at strike, about 2% of SpaceX fully diluted shares. Kind of the, let me get a sip. going a little longer than I thought. I always feel that way. So much for 20 to 25 minutes. One day that's coming. For now, they all appear to be 45 minutes to an hour. The punchline at IPO valuations, that stake alone could be worth maybe 35 to 40 plus billion dollars. EchoStar's entire market cap is in the high 30s. You're buying the SpaceX stake and getting the legacy telecom business and a delevered balance sheet, what feels like for free. Citi upgraded it. Morgan Stanley upgraded. Now the risk, yeah, they are there. The FCC, the DOJ approval's not final until probably mid this year. The stock has already run 500+% in 12 months. High conviction, high valuation, regulatory binary. But if you want public exposure to SpaceX IPO, that's what, maybe 2 or 3 months away. EchoStar appears to be probably among the cleanest expressions on that tape. Now, for higher level qualified purchasers, family offices, your broker, your bank could get you and find you, if you're a big enough allocator, opportunity. And maybe even for accredited investors, a Hive, a Forge, and Equity Zen probably still have occasional SpaceX paper through SPVs. That window is closing fast. Do your own diligence. Things could go wrong. And really any investment could go to nothing, go completely down. I mean, it definitely is tied into an Elon risk. What happens if something happens there? So I promised I would come back to kind of what I call reading the book and choosing one hedge fund manager. Maybe I'll do something like this every month, and be informally for years based in Greenwich, something that's a little up my alley. So I don't do this often, actually never done it before, but going through 13Fs, which is limited, but tells us something. I'm intrigued by situational awareness. I've read Leopold's now legendary Leopold Aschenbrenner, his legendary paper, probably a good 2 years ago, always stuck with me. What is this guy, like 26, 27 years old? Former OpenAI researcher, author of the before mentioned Situational Awareness, The Decade Ahead, which argued AGI could arrive faster than markets price in. He get fired by OpenAI for sharing a little bit of what they deem to be some of their secrets and some maybe fears around AGI, and then, well, converted that into a fund that has multiple billions of dollars now, backed by Patrick and John Collison, Nat Friedman, Daniel Gross. The fund has scaled from originally a few $100 million to easily now, maybe it's $6-7 billion, all inside of 18 months. His thesis lines up almost exactly with mine, or probably vice versa. I'm certainly learning from him. The most valuable assets in the AI era are not the algorithms. They are the electrons, the compute, the memory, the optics, the land, and the fuel. And his book, if I could call it that, at least through a 13F, is now a public expression, so to speak, of that view. So per the most recent 13F, top holdings included my before mentioned Bloom Energy, Lumiton, CoreWeave, Core Scientific, and IREN, with a meaningful Intel options position layered on. In the last quarter alone, again, we're looking at things backwards here. Now, this is where it gets interesting. He aggressively scaled CoreWeave call options, roughly 9.4 million shares of calls added, a 600 plus increase in the position size. He added 8.6 million shares of Core Scientific, 5.3 of Applied Digital, took SanDisk from small to roughly 250 million shares, and 800+% increase. Very impressive. Added meaningfully to Riot platforms. I know many of you have never heard of that one. IREN, BitDeer, EQT, Solaris. I have kind of the printout here. Coherent and Tower Semiconductor. In a textbook move, he sold his now famous to many of you that are following these kind of things closely, his Intel common stock down from 25 million plus shares to 1 share. While keeping the Intel call options, pure leverage on the optionality, freeing up real capital that this young one is a smart one. No guarantees. Maybe it's God knows what happens. Hedge fund managers have blown up before, but smart guy and doing interesting things. So the pattern from Altitude, Bitcoin miners pivoting to AI hosting, Core Scientific, Riot that I mentioned earlier, HUD 8, IREN, Bitdeer, GPU clouds, per again, his book, CoreWeave, Applied Digital, Energy Upstream with EQT, Solaris, optical and connectivity. Even I mentioned Lumitum as well, Coherent, Memory, SanDisk, mentioned them, on-site generation, kind of everyone's darling now, Bloom Energy. I believe that's his single largest holding. So he's not betting on the model layer. He is betting on the physical layer, which is exactly, I believe, might be wrong, what the new framework should tell you to do. Now, you have to read and understand the limitations of these 13 Fs with discipline. There's multiple caveats. I want to let's get a little sober about this. First, 13 Fs show long US equity positions only, not shorts. No full derivative detail, no non-US holdings, no cash, no leverage. So there's a fair amount that we actually don't know. And in Leopold's case specifically, actual reported AUM is closer to $380 million as I'm seeing it here. The $6 billion is more gross exposure, not really net assets. So it's materially, as we could gather, very much levered. Again, 13 Fs are delayed up to 45 days. By the time you see it, the manager has had a quarter, effectively, it feels that way, to change their mind. 13 Fs are interesting for idea generation, sure. They are usually a terrible, terrible mirror to copy. Treat them like a senior peer's reading list. Not a portfolio. And I can't really emphasize that strongly enough. They're intriguing, but they just don't tell enough of the picture. And a lot of these people are hyper tactical. Things are changing so quickly. And looking back at it weeks and weeks and months back, it could be very different now. Maybe I'll throw in 2 intriguing private company bottleneck bets. This more for the qualified purchaser family offices. The biggest bottleneck for AI is simply scaling it's energy, not chips, energy. 2 private companies sit squarely on that bottleneck, both for the LP eligible audience. Sogaldry Technologies, founded by kind of an iconic figure in Chad Rigetti. Yes, the Rigetti from Rigetti Computing, alongside Adalia Friedson and Michael Kaiser, building quantum accelerated AI servers. We'll see. And one probably a little bit more, and the last one from this, a little bit more well-known in general matter, founded by Scott Nolan, former SpaceX engineer and founders fund partner. Peter Thiel is on the board, if I remember, a rare board seat actually for him. They produce, I guess we pronounce it HALEU, high assay low enriched uranium, the fuel nearly every next-gen reactor design needs, and which today is kind of functionally controlled by Russia. It's an interesting company. Like a lot of private companies, who knows? But for those that are qualified and have access and resources, I think it's to me, that are interesting. So let me get a little back to, now that we spent a pretty fair amount of time throwing some names at you, that again, when you invest, you absolutely could lose money and you could lose all your money. Understand that. So kind of a revised decision matrix. Let's get back to it. Here's how I now rate near every position on kind of a little bit of a 1 to 10 scale. Boy, you're getting some of my secret member sauce here. It's okay. Probably you're half asleep watching this anyway. One, AI proof moat strength. Can AI commoditize this? Two, cash generation quality unchanged. Three, AI era runway, compressed timelines, new adjacencies. Four, compute data and networking position, the new supply constraints. Five, real time growth, quality, faster signal, sure, than quarterly. I would say six, really important one, capital allocation plus AI deployment capability. Elon is considered a kind of a capital allocation master, but who knows in the future? Maybe that changes. Seven, management era AI judgment, adaptation speed. Many companies are not winning that. Eight, risk adjusted return versus alternatives, kind of unchanged. Nine, AI leverage ratio, revenue per employee trajectory. 10, commoditization resistance. How fast can AI replicate this? I think forget the labels, kind of forget the growth, forget especially like even definitions like value, at least for the sectors that I'm talking about here. Although I think it's much broader than that, but we'll see. Ask really in any investment, is this a good investment now? And then how about in 6 months, in 1 year, in 18 months? What is AI going to do on that timeline? Suppose, like I said, at 5 or 10 X's. I used to love the idea of buy and hold. And for certain things, I still do. I just think things have changed and we need to adapt to that. So I go back to a little bit in my close, the sovereign advantage. I'll leave you with this. The frameworks that worked for the last 50 years, well, they still may apply partially. The investors who refuse to update will watch their portfolios get disrupted or not get the returns they want to get alongside the companies they own. The investors, I don't think I'm going on new ground here, who adapt, who think about adaptive advantages instead of static moats, about electrons and optics and inference cost as much as cash flow. If I could learn this, you could learn it. Will compound for the next decade. Direction, I believe, and I know others will disagree, you might be right. Direction matters more than timing. Adaptation matters more than perfection. And being in the right rooms matters, well, I could say more than either, which brings me to the ask. At my private intelligence and strategy community, built primarily for family offices at SFO continuity, we aren't just looking at tickers. We're looking at really the first principles of wealth survival in this era among peers, founders, allocators, and some of the sharpest investors in the world, all better than me, who I learned from. We share what we own, what we passed on, what we got wrong. That's a great one. And what we're kind of stalking next. The second order edge, the compounding of relationships and conversations across cycles, is the most undervalued asset in modern investing. This era, I just don't think, I wish it did. I don't think it's going to reward the patient observer. It rewards the tactical builder. If that sounds like your kind of room, let's talk. Become a part of what I've built. As I begin to close and share a little bit of the upcoming week and next week, and maybe field a question or two, this is my disclaimer, which I've noted throughout. This is simply for informational and educational purposes only. It's not investment advice. It's not a recommendation. It's definitely not a solicitation. I may hold these positions that I noted in name, and maybe tomorrow, poof, I change that. And bringing up situational awareness and 13Fs only show certain U.S. equity positions, as I noted, and exclude so much shorts, derivatives, non-U.S. holdings, and effectively leverage. Past performance doesn't predict future results. Consult your own advisors. You have your own liquidity needs, risk tolerance, and timelines. When you invest, you can absolutely lose money. You could lose all your money. due diligence, and make your own decisions. So, in taking it a little bit to the home stretch, this was a little different. I haven't done something like this probably since December. And conceptually, some of my decisions and frameworks have adapted in a couple of months. And I actually haven't been moving in and out of some of these satellite positions as much as I thought I would. Right or wrong, I don't know. And again, I have more questions than answers. At the end of the day, I'm a white belt. I want to be learning all the time. I do not have all the answers. I am not a Leopold, who I mentioned, or some of the other most incredible investors in the world. I love to read about them. I love to learn about them. And I've interviewed, mainly back in my family office association days, 5 years ago, 10 years ago, 12 years ago, so many of them, from Ray Dalio to Tudor Jones to Peter Thiel, have kind of come through my doors. And it's an honor to get to hear them speak and to learn from them. As I've grown in my experience, I realize they have imperfections as well. And certain things that they discuss beyond investing, I even have differences and disagreements with. Lord knows I'm not afraid of a little bit of combat and a little bit of debating. I actually find it invigorating in one of the ways that I learn. And again, I am wrong my fair share. I am wrong a lot. I probably would be better off just saying, I got some money in cash, gold, Bitcoin, my properties, and ETFs that are along the market, and call it a day. And maybe I make slightly more than that now. Is it worth the complexity to my life? Well, I wouldn't be doing it, I guess, if it is, but that could be changing pretty soon. I discussed this a little bit in my video yesterday with a lot of aging, and I guess I'm that. Principles and people that might have had a pinch of success. I want simplicity in my life, not complexity. And is it worth it for me to have arguably additional volatility and maybe get 100 or 200 basis points more? It may not be worth that to me. But for some of you, and even for me up to now, it is. I like the mental stimulation. I like being in the game. It's exciting to me. I love what I do within the family office community and really everything around it. Structuring family offices, architecting, dealing with the principals, the spouses, the children, the rising gen, all the issues I discussed yesterday. And obviously, I greatly enjoy geopolitical, macro investing, and a little thing called AI that many of you by now are familiar with my conversations around that. It's quite a time to be in this community. I greatly appreciate all of you on the live, or those of you that watch this in video or recording. Again, we're doing this on a Monday. What is it? April 27th. And again, I may wake up tomorrow and make some adaptations to what I'm talking about. Definitely a week, a month, or 2 or 3 months from now, conditions change. I just don't know. But I do understand when I invest, I could absolutely lose money. And I have in the past. Like, I'm very much an imperfect investor, hopefully learning a little bit, getting too confident when times are good, and then learning lessons when times are a little bit more challenging. Thank you for some of your comments. Very good questions asked. Yeah, I mean, my focus is probably being more aggressive in my portfolio than many of you should be. My concern is if you're not investing at all, like, how are you going to keep pace with the real inflation, with the money printing? How are you going to get ahead? If you're younger, I would absolutely focus on having a skill. Skills have utility, being an entrepreneur, understanding AI. Yeah, that is foundational and most important. Paying off significant debt that is not in an asset like maybe real estate that's at least going up in value, but getting started somewhere, getting some skin in the game of things historically, like stocks, probably through an ETF, that in the past have gone up in value greater than some of the benchmarks and frameworks that I noted that we look at, like inflation and money printing. I know it's hard. Nothing to be embarrassed about. You eat an elephant one bite at a time. You have to start somewhere. If it's just $5 or $10 a month, do it. Start it. I know I'm a family office guy, and maybe these are things like, why do family offices care about that? But I care about you as the audience. I want you to do well. And it doesn't matter who you are. I wish you the best in this journey. Again, I come at it with a white belt. I have more questions than I have answers. Some other comments. I'm not sure Nat Friedman's fun name was that one of the investors in Leopold Aschenberger's situational awareness. And again, in today's world, it's just so easy to look up the 13 Fs and things like that. But don't forget what I said earlier about all the things that are missing from that and how laggard it is as well. And a lot of these managers, they're very tactical. They're getting in and out. They're using leverage. They're doing like a lot of different things. And what did I say? Many of you, if you just stay long-term in something like the Triple Q, you're probably going to beat with more volatility. Sure, likely, you're going to beat a lot of them long-term. You're not going to beat all of them. There are some that are going to be special. We just don't always know who they are. So I do enjoy talking about the thinking and thesis behind investing. I do love what I do within the family office world. You could go to my angelorobles.com and learn more about membership and the value of membership and what we provide, who are often going to be qualified purchasers plus, and obviously my focus on family offices and much, much deeper than just investing. And it really is an exciting time. I've been in this community, kind of feels like forever. I love it. Love what I do. I'm going to be maybe do one more solo. I have some ideas before I head out to LA. I'll be there during Milken Week. I got some soirees and lunches for my members that I'm hosting. Still not too late to go to angelorobles.com and become a member and be a part of it. When I come back, I have some incredible interviews. I got some incredible ideas about solos. I got updates to some of my books. AI is changing so rapidly. That is exclusively for my members. And right around that corner is my June 23rd and 24th, my in-person immersive multi-day AI Family Office Masterclass. My website has all of that on it. You can learn about it. You've probably heard me talk about it enough. And we have some of the most incredible family offices in the world that already signed up, are members, or joined because of that, and are going to join us on that date. And yes, I will do others through the year, and a member could attend multiple of them, because there's value in kind of the compounding effect of that. So you can learn all about it. You know where to go. I appreciate all of you. I think that wraps up a little bit on questions. Thank you all for your time and have a wonderful evening. Thank you.